What's up, everybody? Welcome back to the channel. If this is your first time, welcome. If it's not your first time watching one of my videos, then welcome back. This video is going to be about short exempt volume, short exempt, what exactly short exempt means, and how it can apply. How does it apply to what we're seeing with AMC? Because I was doing my AMC update video earlier, and I noticed on Stonko Tracker here, if we look at the Stonko Tracker data, we got these couple huge numbers. They just started recently reporting the short exempt volume here on Stonko Tracker, and these 2 days especially were gigantic compared to the rest. So it made me just start doing some digging, and some of the things that I've come up with are pretty wild, and I'm sure it's just the tip of the iceberg. So before we get into that, if you wouldn't mind liking the video, and if you're not subscribed already, if you wouldn't mind doing so. This is a new channel, trying to get as much support as possible, and any support is greatly appreciated. So here we go. Let's jump right into it. So the short exempt, what exactly is short exempt volume? What does it mean? A short exempt refers to a short sale order exempted from the uptick rule regulation. The uptick rule, is now only applies when there's SSR in place. They can only short on an uptick. Instead of shorting into the bid, they have to wait for someone to meet them at the ask and short, or whatever, uptick above current price anyways, and it helps avoid driving the price down. So when is a short exempt order allowed? The few exemptions to this rule occur during times of a fast moving market, which make for scrambled quotes and trades that may fall outside of the normal bid and ask prices. Short exempt orders are allowed to initiate short selling of securities even during times that may be otherwise restricted. Like if there's an SSR in place and they don't want to short on the uptick, they want to short on the downtick. Because if we go back here and look at these 2 dates, August 4th, August 5th. August 4th, if we look at the chart, August 4th, we had a minus 11.16% day, the SSR in place. The following day, the SSR in place, we had a plus 12.3% day. You mean to tell me that on a day where we had 12% gain, they had to, all right, we'll get into it. All right, let's go. Let's do it. So short exempt, we went through that. Let's dig into short exemption a little bit further. Understanding short exempt, like we just read, short exempt orders are allowed to initiate short selling of securities even during times that may otherwise be restricted. These are statistically very rare. Most retail traders would not experience the effects of these restrictions or their exemptions because the modified uptick rule only kicks in under extreme circumstances. That's the SSR. So the uptick rule is only in place on days where the stock drops 10% and then the following day. The exemption to this rule occurs only in very rare cases within those extreme circumstances. So very rarely during those extreme circumstances, days. So days during the extreme circumstance of an SSR, for example, why would you need all these other days? Why would you need 500,000 short exempt? Why would you need 500,000? Why would you need 600,000 short exempt volume? Why would you need 1 million volume, short exempt volume, on a day that would go up 12%? Unless you're trying to suppress the price. I mean, as a short, wouldn't you want to be shorting from that higher price? Theoretically, if you're going short, you want to short it from the higher price and you want to go down. So why? I mean, it's obvious. These are rhetorical questions. Why are you shorting against the grain? Why are you going against the SSR for 1,109,457 shares? Because, I mean, you're doing yourself a disservice. You're shorting down. Doesn't make any sense unless you're trying to do something fishy, yeah? All right, back here. Short selling in securities is intended to help participants profit during falling markets, bring more participants into the market at a time when investors may be retreating, to discourage any amplifying effects in the panicked market. The SEC implemented regulation show in 2005. That's the uptick rule. It was always a rule, uptick, always for shorting. And then they changed that in 2010 when they introduced the SSR, loosening constraints on short selling. Prior rule allowed investors to only partake in short selling when the underlying security experienced an uptick. Okay, so I got myself a little confused there. So the prior rule allowed an investor to only partake in short selling when the underlying security experienced an uptick. Now they're letting them do it whenever they want. And yeah, that's what I said. All right, let me stop thinking too much. Let me just stop thinking. The standard market procedures require all security trade orders to be marked long, short, or short exempt. Short exempt marking was added under the 2010 modification. So when they added the SSR uptick rule, they added short exempt. So it was meant to be made, it was made specifically for exemptions in those time periods where the SSR is in place. If there's a good enough reason to short outside those parameters during an SSR day, I mean, I'm guessing there's other reasons, because obviously there are, because we've seen the short exemption on days there's no SSR. So I'm sure there's other reasons somewhere that there's a reason to mark something short exempt. An order to buy is to be marked long. An order that complies with show regulation marked short. A short sell order marked as short exempt is an order that is being transacted beyond normal procedures under regulation show. Though the SEC oversees brokers who issue short sale orders, they do not execute regularly scheduled audits or require regularly filed reports by brokers. Instead, the SEC expects the broker-dealers to be self-regulating by maintaining a huge problem. We'll get into that after we're done with this little bit here. By maintaining their own records, which are subject to audit at any time. With this in mind, broker-dealers are required to document their policies for how they mark orders as exempt and, if audited, provide evidence that they have followed their documented policies and procedures. Their own documented policies and procedures. So they're self-regulating. They make their own policies and procedures, and they mark orders, short exempt if they deem fit, unless the SEC audits them, looks at it, and decides that it was incorrect. Broker-dealers therefore mark an order short exempt if they believe it qualifies for an exception. If they believe it qualifies for an exception. The primary exception is the use of non-standard pricing quotes for trade execution. That means that if the prices come in outside the national best bidder offer, they can initiate a short sale order that they judge would have qualified as an uptick in more orderly markets. What does that even mean? If there's an uptick, there's an uptick. If there's not, there's not. Marking for these orders is signified by SSE, short sale exempt. All orders marked SSE will be closely checked by self-regulatory organizations and the SEC for compliance with regulation show exceptions. Give me a break. Self-regulation everywhere. It's fantastic. So if we go back over here to those two, hold on, let's go back and look at these 2 days here. So what we got, the 4th and the 5th, we had a 900,000 and 1.1 million. So based on keeping in mind what we just read, 900,000 shares, short sale exempt, 909,759 for this day here, August 4th, an 11% decline. We had the short sale rule, SSR, in effect. And wouldn't you know it, almost a million volume short exempt. The following day, when the price was rising, what do we have? 1.1 million 9,457 shares short exempt that they couldn't find an uptick to short on, apparently, during a day where we were up 12%. That's mind-blowing to me. I mean, we know what's happened. We know what that means. So what's going on, right? So let's go back. I looked into this a little bit, and here's what I found about that. If we go back to this little finding here. So the SEC, this is an article that came out May 2021. So this is a recent article. SEC takes BTIG to court for alleged short selling regulation violations. So I started looking into this, and down here you will see it has, according to the SEC's complaint from December 2016 through July 2017. Remember this, December 2016 through July 2017. BTIG mismarked as long or short exempt over 90 sale orders from a single hedge fund customer. Now it's not, the customer's not named, but I'll give you one guess. Totaling more than 250 million in his sale orders and comprising nearly 160 million shares of stock. 160 million shares of stock, okay? BTIG's customer was not deemed to own the shares. They did not have title to the stock. They had not purchased or entered into an unconditional contract binding on both parties thereto to purchase the stock. They did not own a security convertible into the stock. It was a naked short. 160 million naked shorts. BTIG also did not have the shares of stock that the hedge fund sold short. Let's back up one quick second. BTIG's customer was therefore quote unquote short, and BTIG should have correctly marked the customer's sale as short, and they did not. BTIG also did not have the shares of stock that the hedge fund sold in its possession or control, and did not reasonably expect to receive those shares by the settlement date. Accordingly, BTIG should have marked its customer's sales orders as short on this additional independent ground. On each of these over 90 occasions, BTIG also failed to borrow and locate shares before executing these effective short sales in violation of Rule 203B1 in Regulation Show. So, they've gone after, this is, like I said, this is a very recent lawsuit this year, but it's something that occurred in 2016, 2017. According to the complaint, BTIG failed to verify that the hedge fund was deemed to own the shares. They didn't have the shares. Nobody had any shares. Everybody sold, they sold short. Everybody's happy. They thought they were happy till they got caught, Also, throughout the relevant period, BTIG ignored red flags indicating that the hedge fund was making false representations concerning its ownership of securities, which led to BTIG's improperly marking the sale orders as long and short exempt. Short exempt, eh? You don't say. BTIG was aware of the hedge fund's repeated failures to deliver stock for timely settlement. All right, so this hedge fund, who could it possibly be? All right, I think we know who that was, and let's look at this here. Now remember, 2016. What did it say? December of 2016. I forgot my own dates. I told y'all to remember them. December 2016 through July 2017. Here's an article. Citadel Securities head trader joins BTIG. BTIG announces appointment of Chris Amato as head of ADR conversion trading. Citadel. Well, let's go to the date here. November 28th, 2016. Okay? November 28th, 2016. From December 26th, he wasted no time. He got in the end of November, and they immediately started doing the little dance, right? So this isn't something that is new. This isn't what I want to know, what I would like to know is why. What's their reasoning for marking 2 million shares in 2 days short exempt? You know, but I am not the SEC, but hi SEC, right here. You know, if we go back to July 23rd, July 26th, you know, another 1.1 million. We go to the chart on July 23rd, July 26th. We were, you know, they're trying to push it down here, and then we were turning around for a little breakout, trying to come up here. I don't know, but 1.1 million in a day. On a day we had SSR. So what's their reason? Oh, outside normal parameters, or whatever the heck their excuse was. So basically, like, if a stock is falling too fast, they, you know, oh well, I can't, you know, it's moving. I want to short it, but it's just going so fast. You know, just let me short it on the downtick. Let me short it on. And so they shorted on the downtick, and then it just keeps going and going and going. You know, I mean, whatever reasons they come up with that they write in their little document, stuff like that. I mean, we go back to the chart here on those days, on the 1 hour chart for the 4th and the 5th. Right immediately it opened on the 5th, it plummeted back down below $30, you know, below 29 down to 28.86 or so, 28.91, and then it came back. So they were, this first hour of the day was a crazy hour. I mean, it was up and to 33, and it was down to 29, and it was, I mean, it was a crazy hour. And then it just was up for the remainder of the day. So where did you come up with 1.1 million shares that you needed to write off as short exempt when the entire day wasn't up from the time where they failed to push it down on? So anyways, I found that to be very interesting. I think this is completely ridiculous and unacceptable, and I think I'd love to know. Like I said, I'd love to know why. But anyways, that's, like I said, that's the tip of the iceberg. That's all I've got for this video. I hope you guys found it a little bit informative, a little bit fun, a little bit interesting to see the history here, and to look at this short exempt volume, and to be able to trace it right back to old Kenny G, and right back to Citadel, right back to the people that they work directly with. There was another, you know, I found something about between them and Bank of America. I mean, it's the whole can of worms. But that's all I got for this video. Appreciate you guys watching, and I will catch you guys in the next one.